Okay, so we are going to complete the last exercise that we have to do in this in chapter one. The last exercise is give me one second. Where is this? So we completed exercise 1-1. We did also completed the word 1-2. You can do your work in Excel, especially, but the rest of the chapters, the rest, I think I give you the template. You can use the template uh, for the rest of the homework package on the Brightspace. So you can do that unless you want to use your own template. You are allowed to also use your own template if you don't want to use the one I provided. You can use your own template as well. So we completed, like I said, we did the 1-2. This is the last one for the homework package. So remember, chapter one is all about the calculation or determine the goodwill, right? The extra money that you are paying because the company is doing well, and you look at the future of the company based on your observation, based on your calculations. You think that this company is good for you to want to buy the company. So this one, if you look, I said that passing company is trying to purchase this company. They are trying to get this company, trying to decide whether or not to acquire the Desiree Incorporated. The following balance sheet for Desiree is incorporated provided about the books. Estimated market value are listed based upon the company appraisal. So they did some little digging, and this is what they came out that this company have the current assets of 130,000. In the market, there's no change. The value is not changed. But with regard to the PPE, the PPEs in their books is 325. In the market is about 370. So it went up. It went up to the world, a difference of maybe 50,000, 35 or something. So the total asset is now 500,000, not 445. The liability stay the same. They have the common stock, they have the retained earnings, they have the total here. Now, Passion Company expect that Desiree will earn approximately, this is the key here. This company is going to earn approximately 75,000 per year in the net income for over 5 years. So they update their calculation and they find out that this company is going to give them approximately $75,000 per year. Now, this similar one is compared to the what in the market. And in the market, they find out that this income is higher than the what? The 12% annual. So this income that they are getting here is higher than the what? The 12% income. Remember the step, the normal rates and also for the similar company. 12% higher than the annual return to tangible asset considered to be annual industry norms. So A, you are required to compute an estimation of goodwill based on the information above that Passion might be willing to pay, included in its price under each of the following additional assumptions. So one, Passion is willing to pay for excess earnings. They are willing to pay for any excess earnings live for 5 years. This is what undisclosed. It means that it's not discounted. They're not going to discount it. It's undisclosed, discounted. B, Passion is willing to pay for excess earning for an expected life of 5 years, which should be capitalized in the industry rate of return of the what? The 12%. The 12%. So meaning that they are going to capitalize the return for 5 years. They're expecting this return to come in, not indefinitely, but 5 years. They're expecting to this return of the word for 15 word percent. This is where the table comes in. You have to use the table. Now, three said excess earnings are expected to last indefinitely, meaning that the extra money they are going to get different between the normal industry and their amount they are earning every year any extra earnings. It's going to last forever. Therefore, we have to use the word perpetuality, where it means that we have to divide it by the what? The 20%. B, comment on the relative merit of the three alternatives. It means that from 1 to 3, which one you think is the best for the company? And then the last, determine the amount of goodwill to be recorded on the books if the company pay 400,000 cash and assume the liability of the company. So let's do like what we did. Let's do the first part. So this is part A. Now, part A, first we have to calculate the normal income in the similar company. So normal earnings for similar company or similar firm, which is based on this is going to be based on the tangible asset, the company tangible assets that was given here. Now we know that the tangible asset here was given to us. That is 500. We use the market value, not the book value. So we are going to take the 500,000, multiply the market rate, which was given right here. The market rate was given at 12%. So this at 12%, those with the calculator, how much do we have? How much is it going to be the similar company in the market? How much is the earnings of the company in the market? What is the rate of return? Anyone?
60,000.
60,000. So
60.
we have 60,000. Okay, so 60,000 is the rate of return in the similar company in the market. 60,000, which means that's why they were telling that 75 is higher than the market rate. So therefore, our excess earnings is equals to, we did the excess earnings, which meaning that the difference between what the market is offering or what the market is saying and what you are having. So this is equals to our 75,000 minus the market similar company return of the 60,000. That give us the excess earning here is going to be amount of the 15,000. That's the excess earning. When we buy this company, we are going to enjoy the excess earning of the 15,000 every year. That's how much we are going to enjoy, 15,000 every year as an excess money. Now you can answer the question 1 to question 3. You can answer it. 1. What if the company is to pay excess earning for expected life of 5 years? It's undiscounted. So A, which means that this one here, number one here, our goodwill based on 5 years undiscounted, excess earnings is equal to 5 years, 5 times 15,000, 5 times 15,000. So how much do we have? 5 times 15,000. If I'm not mistaken, is it 75?
Yes, Professor.
75. Thank you. It's 75,000. Okay. Now, if you look at the next one, that is number 1. Number 2. Number 2 is saying that if the goodwill Passion is willing to pay for excess earning for an expected life of 5 years, which should be what capitalized at the industry normal rate of the 12%. Normal rate of the 12%. So this is based on what discounted. So goodwill based on discounted. Goodwill based on 5 years discounted excess on the excess earnings. So let's read from the table, which is going to be 15,000 multiply. So I'm going to attach this thing, and somebody should tell me. Remember, 5 years and 12%. So what will be the return? 5 years and 12%. So we have, this is the table here. So 5 years. Give me 1 second. I have the table. Where is the table? Okay. Give me, I'm going to attach it again. I need the table. Okay, good. So can somebody read it for us? 5 years.
3.605.
3.6. Yeah.
Okay, so good. Thank you. So let me go back and attach it and let's do it. So so based on what you are saying, it's supposed to be what
3.6048.
6048.
Thank you. 3.6048. So therefore, how much is the estimated goodwill? How much is the estimated goodwill? How much will be the estimated goodwill here? Mm-hmm.
54,000.
54,000
72.
and 72, like this?
Yeah.
Okay. So the third one, the last on this part one, is saying that excess earnings are expected to last indefinitely. It means that forever. It's not going to stop. We are going to enjoy this excess earn of the 15,000 forever. So let's now take it up. So 3. Goodwill based on the so we know, therefore the goodwill of the 15,000 divided by the what, the 0.20 was the 20%. So 20% the same as 0.20. So how much the goodwill here? How much will be the goodwill? Is it 75?
75. Yeah.
75,000. The goodwill they are. So the extra money they are paying to get this company is 75,000. It's 75,000. And the B, this one I'll leave it. I'm not going to do it. You have to comment in the homework. You have to comment on this one. But mathematically, this one, the second alternative is the best one because he used the word. It presented as what this one is the best one here because this take into consideration the discounted, the future discounted. So you have to elaborate it more. Why is that one important? But the answer is the 2 is the best option because it take into consideration the excess earnings, and also discounted. You take it one here, this one doesn't take it to the word discounted, so they are not discounting it. Even though this one is good, but because it's going to last forever, it doesn't take the discounted. This one take the future discounted together, so it's kind of the best one. So let's do the parts. Part B. Part B is saying that, okay, what if the company is saying that they are going to pay 400,000? Then what will be the goodwill?
Professor,
What
what
will be
that
the,
mean for the discounted? I'm just
you
confused a
know,
little bit.
okay, very good. The discounted, discounted means that we are taking into consideration the decline of the future, maybe dollar amount going down or going up. So we are taking it into consideration, right? The first one, we are not taking into consideration what happened if the dollar decrease, right? What happened? We are not taking that one into consideration, the decrease in the what? The dollar amount. But on B, or the second one, we are taking into future discounted. So we are taking into consideration, like for example, how much do I have to invest to get $10,000 in the 5 years from now? You are using a discounted this thing in order to get how much if you invested today is going to earn you in the world in the 10 years or 15 years. So you are taking discounted factor, ordinary annuity into consideration, which means that you are bringing in if something happened, is already calculated part of the word, the discounted already. So that what we mean by the word, the discounted, taking into consideration the future dollar amount. Is good, Fatima?
Yes, Professor. It means like it's 54,000. We're gonna pay them more, right?
Yes. So
Okay.
that's what we are
Okay. So
predicting
we
for the
just
future
yeah. So
5
it's
years.
like
Yeah.
they say like we have like earning 75, but we are paying more like a 54 in case something
That is,
happen.
yes, in case something happened. Yeah. So part two said that what if you are paying them 400,000? Then what is the goodwill? Now, you all know the goodwill here, the formula for the goodwill, it will come back again on chapter 2. Goodwill normally is equals to net cost, net identifiable assets minus the, you guys remember the consideration. Who can tell me what the consideration is for? What is the consideration? We talk about the chapter.
It was a debt, cash, and I forgot the third one.
Stocks,
It was
right?
stocks. Yes, stocks.
You can give the what? You can give in to get the company. You have three options. Either you give in the what? The cash, or you give in the what? The stocks, or you give in the what? The note. In this case, the consideration they are giving is the what? It's cash, right? It's cash. So the formula said take your what? Your nets. So we know that our net identifiable asset here, net identifiable asset is equals to, in bracket, they give out the total asset. The asset is a what? 500,000. So 500,000 minus their what? Your liability, which is 200,000. So this give us an amount, if I'm not mistaken, is easy 300,000. Am I right? Less the what? The consideration that we are giving. Less the what? The cash. In this case, is cash, right? In this case, is the cash that we are paying. So cash or the consideration, we are giving them what? 400,000. So the value of the company is 300,000. Meanwhile, you are paying them what? An amount of give me 1 second. You are paying them an amount of the what? The 400,000. Therefore, the goodwill is equal to what? What would be the goodwill? How much the
100.
goodwill? The
100.
goodwill is a 100,000. The goodwill in this case is a what? Is 100,000. The goodwill is 100,000. So in this case, the goodwill that you are paying, or you are paying extra money, the 400,000 that you are paying is include the goodwill of the what? 100,000. Any questions? Any? As we bring the chapter 1
Yeah,
to an end.
where did you get the 500,000?
It's right here, the market value of the total asset here.
Okay.
The asset is 500. The total asset is 500,000.
Yeah.
Okay. Any questions? Any? As we bring chapter 1 to an end, any questions? which means that you have 1 week to make sure you complete the homework and it's submitted. Let me because all the homework that we did here, let me go see if I can. Give me 1 second. If I can log in into Brightspace here. Okay, so I want to show. So if you look at the course content and the one submit the work, this is the present value you can use to calculate uh this is the solution. I think one of them is this questions, right? If you look at this question here, this is a similar one, like the one, only that the numbers are different. The one we did in the class is the same question with the different numbers here. If you look at this, is the same here, only that here you have to add these numbers and know the total. What is the total identifiable? Know this one. We did this one in class. This is the one we just completed. It's similar to this one. So it means that everything is done. Now the solution, let's go back to the solution which can help you is right here, chapter 1 solution.
The
We
homework
did this one.
is done in Excel, or how are we submitting it?
It's up to you. If you want to do on Excel, fine. If you want to do it the way we on the Microsoft, this in the Word document is okay. But the chapter 2 going, I gave it a template, which you can use the template.
What do you mean?
The chapter 1, okay, you see this one, this is the answers, right? That would, if you look at this is this one here, 1-2, we did this one here, everything is here, is done here. What I'm saying is this, let me go back and show you. You see, when it comes to the questions here, these are the questions, right? You can do it in the Excel, like the way we did it. You can answer them in Excel. Actually, don't include the questions because the questions, I know the questions already. Just produce the answers is what is needed. On chapter 2 going, if you look at chapter 2 here, let's look at chapter 2 here. So here you have the templates that you have to use. This is a chapter 2 homework assignment here. So this, you don't need to create your own templates. This is the questions here that you have to do on chapter 2. The template that you can use to complete it is right here. You can use this template on chapter 2. So you don't need to create your own template on chapter 2. I don't know whether I've answered the question. Have I answered the question?
Yes.
Okay, so it's created, so you don't need to, but only chapter 1, you can create your own. You can use Excel, fine. Because if you look at what we did here, I'm going back to our Excel. I use the Excel because I think that it's kind of cool or easy for the calculation. So you can also use the Excel. And if you are using the Excel, don't bring the questions. Just bring the answers. Just do the answers here is what we just needed. You can do. Don't bring the questions before you answer them. It's good. Any questions? Any?
So, yeah, please, can you
Okay.
show the last part result?
Oh, this one.
Yes, please. I was thinking if it is 300,000 minus 400,000, wouldn't the 100,000 be in bracket? Isn't it a
Is that very good? That you see, I was expecting somebody to ask that question. That's a good question. Now you don't need to bring the bracket because it's an extra money you are paying. You don't need.
okay?
You
Okay.
can I can first bring this one here. Consideration, let the what the this is the net identifiable asset. You can do that way. Yeah.
Okay.
And that's a good question. This is just showing that you are paying more than to get a company. That's all what is happening. You are paying more money than the what to get the company. And what they do, like I said, all this research, they do all this research before they will decide, okay, we can get this company. We can get it. Then they will go ahead and buy the company. Any questions?
Yes,
So yes, go ahead.
if you go up to the book value and market value, does it
Yes.
make any difference what we need, like, to see the details of it or no? And why we need the rest of the information?
This one?
Oh, no, the whole thing. Like, do we need that information with details? Like, why would that
No.
everything would be given to us so much?
Oh, everything. If you look at the homework, let's go back to the homework again. Where is the right space? I think, yeah, good. I think it's here. Now, if you look at chapter 1, I'm going back to the homework again. If you look at the chapter 1 homework, this is the questions. So let's go to the questions here. Number one, they give you the what? The has identifiable asset of this. This here. The typical difference is as this was 7.5. In the class, this was 4.4 million. So all that here has been given to you. In the class, I think this is a 480. Everything given. When we come here to, you see, this is the one we just did. It was 5,000. In the homework, the award is 1 million. So all the numbers, they have to give it to you in order for you to help you to do your calculation. Is good?
Yeah. So this is I understand, but why would so many other numbers would be given to us?
Which numbers like what? This one?
The rest that we didn't use.
Because it's a balance sheet.
Oh, okay.
It's a balance sheet. It's a company balance sheet. So we cannot cut some of the numbers and leave them then right because it's a balance sheet that we are comparing. It's good.
And then we have to use market value, not the book value.
Everything that is, remember the GAAP rule and also International Financial Standard Board, you always have to use the market value when you are buying the company or when you are comparing. You always have to use the market value.
Thank you so much, Professor.
You're welcome. Any other questions as we be in the chapter 1? Any? So you guys have to start for chapter 1 and make sure that you submit the chapter homework. You have 1 week, so you have enough time to be able to submit it. So let's talk later. Now on chapter 2, we are now going to give me 1 second. Where's the lecture notes? Okay. I did open it. So chapter 2, we are going to look at accounting for business combination. How do we account for business? In other words, what are the journals that we have to do, including the income statement and the balance sheet for business combinations? So what are the major changes in accounting for business combinations since 2001 when the GAAP was amended? That we look at the what? Discuss the goodwill impairment test. You guys did the goodwill when you guys were doing the intermediate accounting. If you mind back, intermediate accounting 2, you did the what? The impairment. Impairment simply means that we are testing the goodwill. Remember the goodwill that we just did, that some of them was 75,000, some of them was something if you use the annuity, some of them no problem. Some of them is so every year we have goodwill. Because goodwill was written off as part of the cost and capitalized. But now the new rule says you cannot capitalize the goodwill. We are going to see very soon. But you can test the goodwill every year and see if you have lost the value, some of the values of the goodwill. Those are the 2 steps to test the goodwill. We'll go through in this chapter. And also how acquisition related expenses are. Before there was a treatment of so many the expenses. Some of them had to be capitalized, some of them had to be expensed out. The typical example is the before they incur the R&D, research and development, they have to amortize it. Now he said no. The new rule said no, you cannot amortize it, you have to expense it out. So we are going to look at all these rules here. So changes that have been made since 2001 financial standard board. One is the when you want to buy the company, we use the purchases method. Now we don't use that word again. We use the word acquisition method, meaning that you are acquiring the company. So we don't use the term purchases method again to account for the business combination. Now we use the word acquisition, meaning that you are acquiring the company. You are acquiring the company. That's a new development that was accepted of the business combination on the ASC topic 85. More details on the business combination. It's no longer purchases. It's now known as the acquisition. You are acquiring the company. And these are some of the rules that and the policy did. For example, 1, issue measure date for the issue. When do we have to look at the price and said, okay, today is the closing, so these are my issue the stocks, the price of the before. We use a reasonable period of time, meaning that the can decide by themselves to use how much price they have to put on the closing date. On the closing date, the day they have to bring the company together, before and after terms are agreed to, and then they have to announce it. The new rule said that no, you have to use the fair value of the acquisition date. So what does it mean? Let's assume that people want to buy maybe Yahoo. Before Apple company and the Yahoo have to decide how much the stock price is going to be. How much are they going to value the securities on the day of the acquisition? They have to decide, okay, let's make it maybe $100 per share or maybe $200 per share, something like that. The new rule said, no, you can't. You have to use value. So let's assume that on the day of the closing, on the day to announce to the public that officially AT&T and Verizon are now combined together, they have to use the price of AT&T because maybe it's the Verizon who is purchasing the AT&T. They have to use the stock price in the market on the day of the acquisition. So if AT&T stock is now $200, they have to use the $200 to value the stock. If the Verizon is $250, they have to use the $250 to value the stock, not the par value they have. Or before they have to decide when or the price they have to use. So the new rule said that no, you can't do that. use the price in the market, the fair value in the market on the day of the closing. Use the day, the amount of the stock. How much is the stock going? Use that one. 2, acquisition cost, which is before you have to capitalize it, right? The cost that you incurred, maybe you pay a little, the broker, you pay all these people before you said capitalize it. Now the new rule, the new current or the rules that you cannot capitalize the word acquisition cost, right? Expenses as they. So if you spend 1 million or $500,000 for the lawyers, and also maybe the issue price of the stock, somebody broker, do not capitalize it. Now expenses. Next one, acquisition of the control, but less than the 100%. If company have less than 100%, it means something. If you gotta remember, I make mention something like a word, non-controlling interest. Before, if let's assume it that the parents are acquiring 90% of this or 90% of the company, which means that 10% is 100%. The company have the 90%. There's another group who own the 10%, who are the before this 10% group here are known as the minority. That's what we are saying, as a minority. Now we say no, record it as a non-controlling interest. It's recorded instead of using the word minority as a name. Now use the word non-controlling interest at the fair value, along with the word 100% of the goodwill. So now do not use the word minority. We don't no longer use the word minority for the outsiders or the part of the company that is owned to outsiders. Now we use the word as the non-controlling interest. The other thing that will change was the R&D, like I mentioned before, is included as a part of the purchase price. But then the expenses, now they say no, included as part of the purchase price, treat it as an asset. So R&D, you cannot expense it out. You have to be treated as a part of the your asset. Why? Because R&D is a research and development, which means that it will continue in the business. So as an asset instead of expensing it, which was before. That is what the company were allowed to do. Negative goodwill. The negative is known as the bargain price. What does it mean? Negative goodwill simply means that you are paying less money to get a company. That's what the negative goodwill is. So, for example, let's assume that the net identifiable asset of the company, which is the value of the company, 100,000, and you are paying consideration, giving them consideration, whether stocks or whether cash, that through the debt, you are giving them 150,000. It means that you gain is a negative goodwill. That negative goodwill is known as what? Bargain. Is known as the negative goodwill is a reduction of the certain non-current asset with the remain as the word extra gain, meaning that before, if you have negative goodwill, what the company have to do is allocate some of the gain or some of the negative goodwill to some of it and the liability of the company, especially the asset of the company. What does it mean? Yes.
Your voice is so glitching, and they have like, I don't know what kind of sounds when you're speaking. It's just like when sometimes your voice is just cutting, and sometimes it's like some
keep on
sound is
cutting, right?
making. Yeah.
Okay. Thank you for letting me know. So let me see. Give me one. Take me 1 second. I want to. What about now? Is that okay?
Yes, it's now better.
Okay.
So before, right, like if they have the negative goodwill, which is the gain, known as the gain, they have to allocate the gain into one of the other assets. So it simply means if the account receivable is maybe 100,000, they can reduce the account receivable. If the inventory is about 50,000, they can reduce the 50,000. If they still have the enough negative.
Professor,
Yeah.
I can barely hear you.
Yeah, me too.
Okay, give me one. Let me use my. Can you guys give me 1 second? Just give me 1 second.
Okay. What about now? Is now okay? I hope
Yes,
so.
Professor.
Okay. Thank you. So, like I was saying, you have to, if you have any bargaining or the gain, before you have to allocate it to some of the assets. In other words, to reduce the sum of the what your value of the asset. Then the rest, treat it as a extra gain. But now they said no, you cannot treat it as an extraordinary gain, but rather reduce the asset is recorded, and if still there's enough gain, treat it as a gain in the income statement. So let's do something. I'm just want to push. I know we are going to do exercise and also the problems. So let's lay this. What does it mean? So let's assume it that the company bought the asset, right? And the gain, the value of the company is 300,000. Let's assume it that. And then they give them only consideration cash of the 200,000, which means that there's a negative gain here of the 100,000. This is known as the word negative goodwill. That's what it means, negative goodwill or bargain. Let's assume that they have account receivable. The company have the account receivable based on the market value is maybe 10,000. Let's assume 10,000. Let's also assume that the company also has the inventory as an asset. They have the inventory here. And let's assume that maybe the inventory is at 30,000 here. Let's assume they have another one, maybe land. I'm just making numbers up. It's a maybe 50,000, assuming that. This gain of the 100,000, they have to use it to reduce the assets, meaning that they are going to record account, they are going to take this gain here as 100,000. They are going to put the account receivable here, allocate 10,000 to the account receivable. Allocate inventory here, they are going to allocate 20,000 of the difference here. Then land, they are going to allocate 50,000 to the land. There's still a balance here. Got this and this is 80. There's still a balance of 20,000 here. This 20,000 before you can use it as an extraordinary gain. Now they say no, the 20,000, which is still a negative goodwill, cannot be used as extraordinary. Rather, use it as a word gain. Gain on purchases. The gain that you gain when you purchase the company and record it in the income statement. Does that make sense now?
Yes,
Does
please.
that make sense? Okay. Now, the next is the what? The contingency consideration. We are going to look at this one on one of the chapters. Now, record when determinable and also the first subsequent changes in the purchases. So, what before? When the company contingent consideration simply means that I'm still using the Apple and Yahoo. Let's assume that Apple have agreed to purchase the Yahoo. Apple can give this in Yahoo something known as what contingency consideration. They're going to tell them, okay, look, if you are able to get 100,000 for next 5 years as the earnings, your earning increased by 100,000 for the next 5 years, we'll give you 200,000 as a free money. We'll give you 200,000 as a free money. That's what is called a word contingency. Before it determine and reflect the subsequent changes in the purchase price. Now you say no, record it at the fair value. It simply means every year I'm giving them 5 years. Remember, we are giving them 5 years to continue to earn the 100,000. So every year we have to measure the contingent liability based on the market value. So if this year, when the deal was done, was 100,000, and then the following year it go up to 150,000, they have to adjust it and send it to the income statement as a gain or loss into the income statement. Based on that, which we are going to do that on chapter 3 or so, you are going to see something like that. Before, the definition of the business combination is defined as a business is defined as a self-sustaining integrated set of activities. Now is not. Is a business is now defined as the word a group of assets consisting of input and process of the word the ability to produce output. So they have all these changes have taken place since 2001. Has been taking place since 2001. Now, the next is acquisition method treats the combination as the acquisition of one or more companies and another. One, you have to be able to identify the word acquirer, who is buying the company. We have to know who is buying the company. Two, determine the word acquisition date. When is the date? When is the date we are going to acquire the company? The last, measure the fair value of the acquiree. So one, using the example that I was using, Apple is known as an acquirer. They are purchasing the Yahoo. Yahoo is known as what? Acquiree. So on the day of they have to measure the acquiree or subsidiary company, their asset and the liability should be measured based on the what? The fair value. Not the book value. It should be based on the fair value. They also have to measure and recognize the assets acquired and the liability that as they assume the liability. They also have to consider that. What if we are buying the assets? How do we account for the asset acquisition? If the company is buying the asset, what is the treatment? How are we going to, in the parent company, how are they going to record the acquisition of the company? So we are going to debit the asset of the company. We are going to debit the credit the liability of the company and the consideration we are giving up. Remember chapter 1. What are you giving up to get the company? So if there's any difference between the two here, you are going to treat it as a what? Intangible asset other than a goodwill. Liability assuming should be what? Recorded at their fair value at the date of acquisition. Any excess of the total cost over the sum of the amount assigned to the identifiable asset is recorded as a goodwill. So any amount that is excess. So let's assume it. I'm just putting some numbers here. I'm just making an assumption here. Let's assume it that all the company asset here is 100,000 here. The company liability here is 20,000. And the consideration they are giving is 80,000 here. We said there's no goodwill because the value of the company is 100,000, and then they are paying it the same amount. So there's no goodwill. But if we are giving them here 120,000 here, then we are going to debit goodwill here. We will debit the goodwill, which is the difference. Goodwill will come here. What is the difference between how much you are paying and also. So here the goodwill in some way, if I'm not mistaken, this is a 140. So this is going to be 40,000 here. Remember the goodwill we said, the goodwill is a what? The formula for one we just did here, the goodwill is always equal to the net identifiable assets.
Consideration.
Like we did, very good, minus the what? The consideration. So the net identifiable asset here is what? 80,000. Which is the what? 100,000 minus this one here. And the consideration that you are giving is the what? 120,000 here. So this is plus 40. So the goodwill is the what? The 40,000. So there are two ways of calculating the goodwill. Or you can just add your credit numbers and subtract your debit number and you get a goodwill as well. Any questions so far? Any? The floor is open. In my class, I always take my time. Like I said, I told you in the beginning, it's not about a grade. It's about you understanding the materials. That is what is concerning me. So this one means that company A acquire all the net asset of the company B. And like we said in the chapter 1, therefore, company B ceased to exist. Company B ceased to exist. The company B is gone. We have only what? Company A. Now, what if we create a new company, like we said, we are buying A and B. So that's known as a what? The statutory consideration. Then you acquire assets. So company C is created as a new company and it is used to acquire the net asset of the A and B. A and B is no longer exist, it's gone. Or whenever the company is buying another company through the asset acquisition, that company will always cease to exist unless the stock acquisition, that is where the other company will still survive. But in the stock acquisition, any company you are buying, that company will cease to exist. You have to transfer all the assets to the parent company. So here the same. Assets of the A will be debit, assets of the B will be debit. Both the liability of A and B will credit, and the consideration you are giving up. If the consideration you are giving up is the what? Greater than the value of the company, you create a what? A goodwill. You create a goodwill. So I will end here, and then Monday we are going to continue the chapter 2. Please, like I said, make sure you start doing chapter 1 homework. Don't fall behind.
Do attendance?
Yes, attendance is already